What's up guys, Andrew White here and welcome back to the second episode of the Ask Andrew W show. In this episode, we'll be talking about blue chip shares. Let's get into the first question, and this one comes from James in Newcastle who asks, what is a blue chip share and how can you invest in them? Thanks for the question, James, and I think it's important that we talk about blue chip shares in general, as you've heard of them, whether it's through your parents, your grandparents, or your super fund who holds a lot of them, or the investor updates. You hear this term blue chip shares thrown around, but I think the general public really don't have a clear understanding of what they actually are. A blue chip share is a large, well-established company that is known for its excellent management and strong financial structure that has operated for many years. A blue chip stock generally has large market capitalization, typically in the billions of dollars. And if you don't know what market capitalization means, all it means is the price of the current share times the amount of shares outstanding or shares owned by current shareholders. So say there was 1,000 shares and the price was $15, you would have a market capitalization of $15,000. While there's no official list of blue chip shares, they are generally the companies that are leading their sector or one of the top three in the products and services within a typical area in the market. So for example, the big four banks, National Australia Bank, CBA, Westpac, ANZ, they're all the large blue chip shares in the financial services. Telstra, you guys might have an account with Telstra, but you can also buy shares in Telstra, and they would be the largest telecom blue chip share in the Australian market. Standard & Poor's, who are a rating agency, list the top 20 market capitalization shares as the blue chip index within Australia. James, you can buy these shares directly through a broker. You can buy them through your banking platforms. So are you with Commonwealth Bank? You can buy through CommSec, NAB have NAB Trade, and Westpac and ANZ have their own platform. Or you can buy these blue chip shares through ETFs, which are called exchange traded funds, and also managed type funds. These two, you transfer the money into these accounts and they just track the top 20 companies as we were talking about before. And as they chop and change, so two companies might move in and out, the money just gets transferred towards owning those companies. If you do go down this route of going through a managed fund or an index fund or an ETF, please make sure that the management fee is quite low, because all they're really doing is chopping and changing where the money goes. There's no real alpha, is what we call it in the investing world, but excess return that they're trying to find. So make sure the fees are low. The second question comes from Tom, who is also from Newcastle, and he asks, why invest in blue chip stocks? These stocks are generally lower risk, financially stable companies that have a track record of long-term growth and increased dividend payments. And if you don't know what a dividend is, these are the excess income that they don't need to use to keep growing the business. So say Commonwealth Bank make $1 billion in profit. They might need half the amount of money to continue to grow the company, whether it's through new technology or new apps or whatever it is, and then they pay the remaining amount out to shareholders as an income, or it's almost like interest from a bank account, but it's called a dividend from a share. These dividends allow you for compound interest. So what you can do is when they pay these dividends each year, you can recontribute those dividends at the same price that they paid them out as, or the same day that they paid them out as. They also have high dividends, and these dividends act as a hedge against any losses in the capital value of your shares throughout the year. You're paid in two different ways, you see. You've got your dividend side, which is the income side, and then the capital gain side or the capital growth side, which is the value of the stock going up. For example, say you bought Commonwealth Bank at $80, and then over the year it went up $20 to $100. You made 25% return on the share, but then you also get the 5% dividend. So there's two components. I do want you to know though, blue chip shares are not recession proof. I mean, if we look back to the GFC in 2008, all four of the big banks, NAB, CBA, ANZ and Westpac, their share price lost half of their value in a matter of months. In the US market, a blue chip stock, General Motors, went absolutely bankrupt in the GFC. While these blue chip stocks are generally lower risk, they are still vulnerable to market movements, especially in recessions like the GFC. Thanks for watching, guys. Hope you enjoyed the episode. Please feel free to get at me on my social media channels and like and subscribe to my new YouTube channel. I really appreciate it. See you next week. Cheers.